Hey, what's up? Welcome to DGenEd. That's degenerative education, meaning none of this is financial advice. Just me having fun looking at charts and listening to earnings calls like Tilray's, which occurred this morning, I believe before market open. And as you can see with the chart, the stock price did come down almost at $2 a share right now, being down 20.66% on the day. So a pretty massive move to the downside. And so I have to say, I did not uh, look into the earnings results from today. I just noticed that the price came down. And yeah, so I'm excited to listen to the earnings call. And I also am pretty, I don't know if excited is the right word, but I am glad that there's still more opportunities to pick up shares at a discount. The low on the day was $2 a share. And it does look like, look at this chart here. This is the daily time frame. We got a number of levels that could be acting as support. And so, looking at that, we do have, let's see, this high that was hit on March 18th, that being at a price of $2.04. We closed just above it on the day. Also, it does look like there is this downtrend, this downtrending channel, really. Parallel channel that price has been residing in with these two touch points here. You could really just think of that as, a downtrending line. Doesn't have to necessarily be a channel. I just thought it was interesting that it had, some price coinciding within it back here, as well as these two little dips here. And yeah, so I do think it is good that price is above that currently. And but I do also think that it is a little bit unfortunate that we did break below the 618. So that is at a price of $2.12.3. So I do think it would be really good for us to close above that in the coming days. And let's see, the open for the day was $2.12. So really, right at that 618 level does seem like it is a significant one. We did get a high on the day going up to the 50% level at like $2.28, the high of the day being $2.25, and the low again being $2 a share. And so, basically what I see with this, I think not only looking at the chart, but also just thinking about sentiment in the cannabis sector. Really, let's see how many days this goes back, how many trading days. So, like from the low here, the ultimate low, I guess the low was also $1.60 on the March 14th as well. So if we take it from that low and go up to the highs, that represents, let me see, how many days? That is 21 days or 14 bars with, a holiday weekend, a 4 day trading day week around Good Friday. That's right around 3 weeks of upward moves going up 85%. I am not too surprised to see price pulling back, cooling off, and I am encouraged that it does seem to be respecting these two levels of support. However, it is quite possible it does trend down along this downtrend to the 786, or maybe there's a quick dip down to that level. But one thing that really stands out to me about the sentiment actually comes from a comment that I got on one of the Tilray videos. I believe it was the one where it was like the kind of like Red Bull video with the guy doing like the space jump or whatever, jumping into the atmosphere. And so I was kind of implying with that thumbnail, as well as, I think what I talked about in the video was just that, the stock price has gone up so much, I could see it pulling back. And this person was commenting that I sound bearish. And, I'm not bearish on cannabis. I think it's going to have a really strong year. But with this big move up, I did think a pullback was necessary. And that person commented, there's no way it's going down to $2 a share. And so, like, whenever I feel like the sentiment is that's impossible, that's never going to happen, I think that means, it's definitely going to happen because there's just so many people who are bullish, who are long. And, after this great move, this is really, the time to be taking profits up here. And so I was waiting for a pullback. I was expecting a pullback. I didn't expect it would go to $2 so fast. I thought the 50% or the 618 would catch it. But we did see this pretty big gap to the downside. And so I'm excited that it's around $2 a share. I had picked up a very small position down here, but I kind of recognized I was picking up too many small positions and it wasn't really worth it to me to be holding so many of them. So I sold around $2 a share. I believe 197, made a small profit, could have made a much bigger profit, but still would have been small generally. Um, and so, I was just like, okay, well, I made my decision. I'm just going to see what happens. And then I see this, I get that comment about it never going down to $2 a share. I decided, I'm going to place an order today for $2 a share. Unfortunately, it wasn't filled, even though price did go down to $2 after I placed the order, just wasn't filled. And I'm just going to try to practice discipline with that and wait for it to be filled. If it doesn't get filled, that's fine. I'm still going to cheer on the stock, the community. But, in this process, I am trying to get better at, trading options and just having conviction in the analysis that I have. And so one thing that I did, I believe maybe it was the fourth, maybe it was the fifth, I'm not sure. I believe the fourth, I started to pick up I started to buy puts. So I bought a put for $7 a share or $7 a contract. And then I traded it for $8 a contract. And it's like, oh man, I was kind of hoping to hold that for earnings. So I did that a couple times, risk $7, make $8. And then the second time I actually got $9 back. So $2 profit, not that crazy. But then just before earnings on yesterday, I picked up a put with this strike for $2 a share that expires not this week, but next week. And, for $7. And it's like, okay, maybe I'll double the position. And so I had a sell order at open for, $14 or 14 cents. And if we do look at the options table for the $2, let's see, put is up here. And so right here, $2, the sell is 14 cents times 100 shares is $14. And so that was filled, but actually at 16 cents. So I made $16 on that. So I thought that was nice that, I had conviction in this coming down and I was able to make, a small amount of money with it, but at least I followed through with that conviction. Now I have a buy order at $2 a share. And so I'm pretty excited about that. I'm excited to, see the next moves to the upside. But anyways, I've been rambling enough. And oh, hey, WS, what's up? Bought in at 224, should have sold at 290. Yeah, I mean, everybody should have sold at 290. 7 cents from the top. Yeah, I mean, it's tough to know, but I think that, and there's somebody else who I don't think they're invested in Tilray, but they were invested in Canopy Growth Corporation. And so I cover, all these cannabis stocks just because people request them. And so I'll do all of them together. They've been moving pretty similarly, just, maybe different percentages to the upside or downside. And this person was saying, before Tilray earnings that, they're just going to hold and, see what happens. And I'm pretty sure that their average was down here, whatever that is for a CGC. So this is not really, not sweating too much. But yeah, I mean, I think that this pullback was healthy. I do think that this did come back to support, and I'll probably do a general cannabis stock overview again over the weekend, and just kind of compare them, see have they come to support. Do I think they're finding a floor, and will they be going higher? Because they have. I mean, that's I think one of the really cool things about the cannabis sector right now is all of these things are moving in sync with each other, and so it's like, well, one of them is having something going on that might suggest some weakness or something else. And with Tilray being up so much, I thought, and also it being such a large market cap, it was about 2 billion market cap. Now it's about 1.5 billion because of this drop. And yeah, I mean, because down 20%, over 20% on the day. And so, with this, I feel like you can see different indicators in the different cannabis stocks and kind of use those to infer what might be happening with them. And so earnings, to me, I thought, oh, well, it's gone up a lot. It might come down. I think the sector will come down. And now I think it's just going to be dip buying opportunities, especially if we see that all of them are respecting levels of support. I'm pretty compelled by this. It does suck that it's below the 618, but there are these two, lines that I've drawn here. I mean, you could take this with a grain of salt, this 204 from the high here. but go a little bit lower, and you got multiple overlaps with these wicks here coming down, definitely to the 786 189.3. If we look at the volume profile, yeah, I mean I feel like 189 if or 190 if price dips down to that, it's a great dip buying opportunity. And with the schedule 3 potential this year, the election, and just the moves that these companies are making, and yeah, I feel like with every election, whether it's 4 years or 2 years, there are new states that are legalizing cannabis, and or making it available for medicinal purposes, and or research. And so I just think that there's so much upside for this, and they've all been beaten down a lot. So I think that this is a dip buying opportunity right now. Maybe it takes a couple months to really start to turn around, but yeah, slowly accumulate now. That's what I'm thinking. But I have been rambling a lot, and I see there are some comments, and so I'll address those in the live chat, and then I'll start the stream, or the earnings call. And so peaceful relaxation. I see. Can it still drop big in coming day, or can it recover? Yeah. So I mean, I think that right now with this, I think if we would have seen, I'm just going to remove the volume profile. If we would have seen the close much lower, I think that could suggest, yes, that it most definitely will be going lower. But since we do, I mean, there's a bigger wick to the upside, suggesting there are more sellers, up here than there are buyers down here, or really just, in the, I guess, above the, let's see, the open, there were more sellers. Below the close, there were fewer buyers, I would say, just because this range is the wicks, the shadows of the candle are smaller on the bottom than at the top. And but there is still a pretty notable wick at the bottom of that candle. And so this could be a spinning top, suggesting that it is going to respect these levels. We do have this gap to the upside now. So the low from yesterday, April 8th, was $2.54. So yeah, I mean, I think that there's, like, for me, I was doing very small additions before. I was going to just do a very small addition, one share at $2, see what happens. I was like, nah, I'll up it. And I'm just doing 10 shares. It's a very small amount of money, but I see that this could hang out down here maybe for a couple months. I think that the one way that Wall Street is able to make money off of retail, what I find, is that they just make things take longer. They make the big moves take longer. People get impatient and they sell at a loss. And so right now with this drop, I think, I'll set an order to buy 10 shares at $2. And then if that gets filled, maybe I'll buy 10 more at 190. If that gets filled, then I'll reevaluate. And then I'll just be accumulating more and more shares over time as it dips. And that's really like the way that is the best way to be accumulating shares is on dips. You don't want to be chasing. And so I try to do that, be patient, and I end up building up pretty big positions over time. And so, yeah, I mean, it hit $2 a share today, but my order wasn't filled. I'm just going to leave it. And then if by the end of the week it's not filled, I'll adjust that to whatever price it is. I don't know if it's below or above the 618, 212, whatever. But yeah, I mean, I'm intrigued by the cannabis sector from the news. It seems like, there's a lot of potential with it, with this move over the course of 3 weeks. And so, I think that with continued good news, states legalizing it around the election, I imagine, I think that it's going to have a lot of good upside, the cannabis sector in general. And I might actually look into other cannabis tickers that might have larger percentage swings, because while Tilray is a larger cap, it does seem like it's probably more stable, a better longer term hold. There might be some that would have bigger swings, like Aurora had, I believe it went up like over 300%, whereas Tilray went up 85%. So I might look into some other ones to have pretty small positions, and maybe Tilray would be a bigger one to hold. But I also, I just don't want to spread myself too thin, that I have too many small positions that the profit's negligible. But yeah, so I mean, I was saying, I don't know if you caught it before, but I'll probably do an update on the cannabis sector over the weekend. Actually, over the weekend, I'm working over the weekend. Maybe I'll do it I'll figure out a time to do kind of an update over the entire sector. And I think that will kind of, the different stocks, the different companies, the different charts will provide insight into, what all of the charts might be doing. Maybe some of them look more bearish than others, and maybe that's kind of a tell that the price might be going down for the other ones. Or if they look like they're holding support, like Tilray is, then maybe this suggests, that generally the sector has found or is near a bottom before going up. Maybe it takes a couple months down here, good time to accumulate before going back up. And, from like current price, not 85%, but from the current price going up just to fill that gap, that's almost a 25% swing. So, I mean, that's good whether you're thinking about it long term or not. And one thing that I had mentioned to somebody in the comments, I try to tell myself this a lot, are you in the stock holding business or are you in the money making business? And so I feel like this, whether it's to hold it long term or for a swing up to like fill this gap, this seems like a good opportunity to make some money. And then, it's like, well, then you decide when you're up, do you want to continue to hold, trim? And so like after being up 85%, I think it's a good time to ask oneself, am I in the stock holding business or the money making business? Up 85%. I'll trim a quarter of my position or half of it. And then if it comes down, I'll buy more. If it keeps going up, still got that other half, but I secured, some gains. So anyways, and I see some more comments. I should get onto the earnings call. And so, yeah, WS says, never know, wondering if Tilray would be the catalyst for the whole cannabis pullback. I think that Tilray probably was. Because, I mean, from the cannabis stocks that I've covered, Tilray is definitely the largest market cap. I mean, it was at, I don't know if it crossed to 2 billion, but it was at 2 billion. Most of them are in the tens to hundreds of millions. I believe CGC is like around 1 billion, but they've probably come down a good amount. So they might not even be, 1 billion. I don't know if I said a million, but 1 billion. They might have come down to the hundreds of millions now. And so I just feel like Tilray is going to be a leader just because of how much money is behind them, $1.5 billion right now. And so if they move a lot, the rest of the market's going to move. Just like if Tesla drops, any EV stock's going to drop as well. And so, I think that Tilray is kind of, like the Tesla in this sector. But there might be another one that's a larger, more impactful. And then MSOX for US ETF times 2. MSOX. I'm gonna look that up here, and let's see. I have my watch list here, but I don't know. Yeah, up here. Cool. So I'm bringing this back, and yeah, let's see. MSOX. Daily ETF, is it? I'm going to assume it's this. Nope, I guess it's not that. MSOX. And this is, what's the profile? Investment seeks daily investment results that before fees, 2x daily total return. Cannabis ETF. Yeah, okay, this is really cool because I had found, I think it was MSOS. And that is not 2x leverage. So this is more intriguing. And so, I just think the cannabis sector is really interesting this year because I think it's pretty clearly found a bottom. I don't think it's going back to the lows that it recently had. So I'm just going to add this to the DGen Ed watch list. I gotta create a cannabis list though of all these tickers. But I don't organize this stuff that well. So I scroll down to the bottom. These are like all the tickers that I've covered on the channel. And so Tilray here. Okay, and so this is the daily time frame. But what I'm going to do, I am going to, actually, I'm going to minimize this so it's not blocking the way. And then it's lined up with my image and the webcam. And so Yeah, yes, MSOS. Yeah, I've already looked at that one. I did do a video on it, but I wasn't aware of a 2x leverage one. That's what I think is nice about ETFs. If you can get leverage on them, then it just makes it, more exciting. And so, yeah, 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 yeah. And so I'm gonna start this earnings call. I'll turn my mic off, and it's like an hour and let's see, I've got it up here in Chrome. It's an hour and 23 minutes long, and I think I can actually adjust the rate, the speed of it. And so I might do it at 1.5 times the speed. I'll see how that goes. Usually, if I'm like at work, I'm busy, and I want to watch a whatever charting video, I tend to put them on 1.5 speed. If I sometimes when I'm editing, I put myself on 1.5 speed, and so that might be nice just because it's an hour and 20 minutes long. Um, but yeah, I'm gonna start that, and I'm gonna plug myself in so I make sure the sound's good for you guys. And then once I get that set up, I'm just gonna plug myself into the computer. And then so I'll be able to hear that, and I'll turn my mic off so we can just listen together. And then I'll probably just play around with the chart, look at it on the maybe 1 minute, 10-minute time scale, see how it kind of moved around. But yeah, I will start this earnings call, and then we can just listen to it, learn more about the company.
Thank you for joining today's conference
And so
call
just
to
let me know
discuss
if the sound's
Tilray Brands'
good,
financial
and I'll
results
adjust
for the
it.
third quarter of fiscal
But
year
yeah, I'm going to turn my mic
2024,
off and look
ended
forward to learning
February
about the
29th,
company.
2024. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session for analysts and investment firms conducted via audio. I will now turn the call over to Ms. Baron Narada, Tilray Brands' Chief Corporate Affairs and Communications Officer. Thank you. You may now begin.
Thank you, operator, and good morning, everyone. By now, you should have access to the earnings press release, which is available on the investors section of the Tilray Brands website at tilray.com and has been filed with the SEC and SEDAR. Please note that during today's call, we will be referring to various non-GAAP financial measures that can provide useful information for investors. However, the presentation of this information is not intended to be considered in isolation or as a substitute for the financial information presented in accordance with GAAP. The earnings press release contains a reconciliation of each non-GAAP financial measure to the most comparable measure prepared in accordance with GAAP. In addition, we will be making numerous forward-looking statements during our remarks and in response to your questions. These statements are based on our current expectations and beliefs and involve known and unknown risks and uncertainties, which may prove to be incorrect. Actual results could differ materially from those described in those forward-looking statements. The text in our earnings press release includes many of the risks and uncertainties associated with such forward-looking statements. Today, we will be hearing from key members of our senior leadership team, beginning with Irwin Simon, Chairman and Chief Executive Officer, who will provide opening remarks and commentary, followed by Carl Merton, Chief Financial Officer, who will review our quarterly financial results for the third quarter and update our financial guidance for the fiscal year 2024. Also joining us for the question and answer segment are Denise Faltischek, Chief Strategy Officer and Head of International, Blair McNeil, President of Tilray Canada, and Ty Gilmore, President of our U.S. beer business. And now I'd like to turn the call over to Tilray Brands Chairman and CEO, Irwin Simon.
Thank you, Baron. Good morning, everyone, and thank you for joining us. At Tilray Brands, we take great pride in our mission to be the most responsible, trusted, and market-leading cannabis and consumer products company across the globe. Today, with our complementary business units, we believe Tilray Brands is the best positioned company in the world to take advantage of all the positive regulatory tailwinds happening globally with cannabis legalization and drug policy reform. In Canada, Tilray continues to lead the cannabis industry with the leading portfolio of adult use brands and the #1 market share. In the event the current excise tax regime were to be replaced with a 10% ad valorem tax based on the value of the product sold and not a per gram tax, We expect an annual savings of $80 million. We also expect to benefit from additional cannabis-related regulatory reforms around marketing and THC potencies. I'll take a deeper dive in the Canadian market shortly. In Germany, Tilray has the leading cannabis market share by revenue for the trailing 12 months, and we believe we are best positioned to capture a large portion of the expected growth in the medical market with both our in-country cultivation facility in Germany and our state-of-the-art facility in Portugal. We also have the ability to ship products from Canada to Germany. In the U.S., Tilray has multiple options, and in particular is well positioned to benefit from the federal legalization of medical cannabis as a result of rescheduling. Yes, we believe that the rescheduling of cannabis from Schedule I to Schedule III in the U.S. would provide a path for Tilray to sell pharmaceutical-grade medical cannabis in the U.S., subject to doctor prescriptions. This is a different strategy from what MSOs are doing today. We believe there's an opportunity to supply medical cannabis products from our existing operations into the U.S. for medical purposes. Further, in the event of a future federal adult use and medical cannabis legalization in the U.S., we believe Tilray is well positioned to immediately leverage its strong global leadership position, know-how, and strategic strengths across operations, distribution, and brands to sell THC-infused products across its robust distribution network and sales channels in the U.S. Today, Tilray is a clear outlier in the global cannabis industry because we're the only company with global expertise in both adult use and medical cannabis. Our innovation comes from GMP certified pharmaceutical grade medicines to all recreational cannabis formats, including THC infused beverages, which also parlays into our beverage strategy. We have rigorous cannabis quality control, regulatory affairs, branding, marketing, sales, and distribution. We also have the #1 cannabis market share in Canada, the #1 cannabis market share in Germany, as measured by revenue, and we distribute medical cannabis in over 20 countries around the world. Since 2019, we quickly developed a diversified and award-winning portfolio of brands, backed by a best-in-class operations in Canada, the U.S., Europe, Australia, and Latin America that supports our goals of becoming a multi-billion-dollar cannabis and consumer products company that addresses the needs of consumers and patients we serve today. As you know, the leadership team at Tilray has the expertise of buying CPG brands and building them into somewhat greater than they were before. Our creative portfolio of beverage brands includes craft beers, spirits, ready-to-drink cocktails, ciders, and non-alcoholic beverages. We are now the 5th largest craft brewer in the U.S., with a 4.5% share of the craft beer market. With over 500 beer distributors alone, Tilray is now dominating key regions across the U.S., with our craft beer brands in the Northeast, Pacific Northwest, Midwest, and Southeast, along with one of the most awarded bourbon brands with Breckenridge Distillery, which continues to gain market share across whiskey, vodka, and gin products. Our wellness brands include Manitoba Harvest, hemp-based food products, ingredients and snacks, as well as our Happy Flower, our CBD-infused beverages, and our recently relaunched Highball energy drinks, which in its first month on Amazon received over $1 million in orders. With the appropriate approvals, we're also looking to introduce hemp-based Delta-9 beverages and products with our Happy Flower brand and across other wellness brands in the U.S. And finally, we own and operate a European medical cannabis and pharmaceutical distribution business in Germany, CC Pharma, also known as Tilray Pharma, with a robust footprint reaching 13,000 pharmacies in Germany alone. With broader medical cannabis use, doctor prescriptions in Germany, we expect there to be tremendous demand for medical cannabis within pharmacies. I can't predict the future, but my belief is there will be a lot of cannabis regulatory changes we've seen with Germany, in Canada and the U.S., and Tilray is best equipped to reach these underlying opportunities, and we have the assets and the tools to reach our goal for Tilray Brands to deliver industry-leading profitable growth and sustainable long-term shareholder value through a focus on these three fundamentals. Maximizing profitable revenue growth through organic growth and strategic acquisitions with strong synergy opportunities. Realizing the benefits of optimized asset utilization and cost management to ensure an efficient cost structure across all our business segments, and to strengthen our industry-leading balance sheet and cash position. During Q3, we achieved net revenue of $188 million, representing approximately 30% growth over the previous year. We grew our revenue across our core business segments. This was achieved by focusing on organic growth of legacy brands and enhancing the performance of our more recent strategic acquisitions. Gross profit was $49.4 million, despite impact of the newly acquired craft beverage brands, which have a lower margin. Our net loss was $105 million, which only $4.5 million represented loss from operations, and cash used in operating activities was $15.6 million. Adjusted gross profit was $51.6 million. Adjusted EBITDA was $10.2 million. Adjusted net income of $900,000 and adjusted EPS of 0 cents. We delivered positive adjusted free cash flow for the quarter. Over the last 3 quarters, we significantly reduced our convertible debt by $205 million, decreasing our net debt to approximately $175 million, and will work to continue reducing our indebtedness, optimizing our capital structure, and enhancing our financial flexibility. The net reduction in our convertible debt will decrease our annual interest expense by $9.8 million, which flows directly to adjusted net loss and adjusted free cash flow. Let's now dive deeper into each of our business segments. We grew our global cannabis net revenue by 33% to $63.4 million in Q3 compared to the previous year quarter, driven by our acquisition of Hexo and Trust, as well as our international business and innovation in the Canadian markets. Net Canadian cannabis revenue grew 31% to $49.4 million in Q3 compared to the previous year. We achieved this growth with the Hexo acquisition, despite price compression totaling $3.1 million from the prior year quarter, and a crippling tax structure that has allowed taxes to spike while prices declined by more than 50%. Excise tax increased by $8.2 million and amounted to $21.8 million, or 32% of our gross Canadian cannabis revenue in Q3, compared to $13.6 million, or 26% in the same quarter last year. Recent enforcement efforts by Canada Revenue Agency garnishing LP payments from the provincial boards is already having an impact on our competitors, over 1,000 of whom have negligible market share. The continued enforcement by CRA, we believe, will lead to further and necessary industry consolidation, perhaps on a mass level. Canada continues to be the largest federally legal and commercial adult use cannabis market in the world, and Tilray Brands maintains that #1 market share position in the country. We are #1 in Ontario, #1 in Quebec, #1 in British Columbia, which together represents over 60% of the population of Canada. We're also #1 in cannabis flower, oils, concentrates, and THC beverages, #2 in pre-rolls, and #4 in vapes, and in the top 10 in all other categories, all while operating under rigorous, high-quality control standards. Our focus in Canada is on 2 things. First, growing sales primarily through continuous launches of new product innovation. And second, taking more and more costs out of our businesses. On the latter, a large part of our acquisition strategy for Hexo and Truss involves removing legacy costs and SKU rationalization from these businesses. For Hexo, we originally target $27 million, but then increased that to between $30 and $35 million, of which we've already achieved $27.5 million in savings on an annualized run rate basis, of which $15.6 million is realized cost savings during the period. Our Hexo integration plan includes streamlining our Canadian operations, improving utilization of our core facilities, improving margins, and maximizing cash opportunities by pursuing divestitures and consolidating facilities. We plan to close the Cayuga facility and move its cannabis cultivation to our existing Canadian production lines. Sell our Maison facility in Quebec, which is currently cultivating cucumbers as a vegetable operator, and sell the Belleville facility and move our manufacturing to our London facility for our beverages. We expect this plan to result in one-time $70 to $85 million of Canadian cash flow inflow opportunity and accretive to margins and net income by $5 to $7 million on an annual basis. From a regulatory standpoint, the expert panel appointed by the federal government clearly highlights three areas of focus which Tilray would benefit from once implemented. First, excise tax reduction, which I've talked about, both in adult recreation and medical would benefit Tilray $80 million. Secondly, there is a proposed opportunity for pharmacies to carry CBD and medical cannabis for medical patients, which would move plant-based medicines into the mainstream as an option for patients to treat ailments. And finally, enforcement against illicit websites, dispensaries that don't contribute to excise tax and put youth at risk through unregulated product channels available easily online with e-transfer and Canadian Post e-mail. We think Canada Post and the Canadian banking systems are responsible for shutting down access to these unlawful establishments. Turning to international cannabis, we grew net revenue organically by 44% year over year to $14 million, and we remain the number one market leader in medical cannabis across Europe, with a leading market share in Germany and Poland. Tilray's international growth has also been driven by increased sales in our existing markets such as Portugal, Italy, the UK, Australia, and New Zealand. The new German medical market opportunity is projected to be approximately $3 billion in the medium term, while the European opportunity could represent a potential $45 billion medical market alone in the long term. Our presence in Europe allows Tilray to grow our global brand portfolio to a base of over 700 million people in Europe, which is twice the population of the U.S. While much of the media attention related to the new cannabis reform in Germany has been centered around cultivation for personal use and the establishment of cannabis social clubs, the new opportunities for Tilray flow mostly from the removal of medical cannabis from the Narcotics Act. This descheduled change is expected to significantly expand the medical cannabis market in Germany, as it would allow for more doctors to prescribe medical cannabis more easily to patients and potentially allow for broader health insurance coverage. We will therefore be increasing our educational efforts to bring more and more health professionals on board with medical cannabis as therapeutic options. We estimate that less than 0.4% of the population in Germany are presently buying medical cannabis, compared with 4% in states like Pennsylvania. In Germany, we also stand to benefit from the abolishment of the tender process for in-country cultivation of medicinal cannabis, which is being replaced with a licensing scheme. We are currently one of the only 3 in-country cultivation facilities in Germany today, and these legislative changes would allow us to better meet patients' need by expanding our medical cannabis product offerings. This would in turn significantly increase our cannabis production in Germany by 5 times more than double our revenue opportunities. Tilray opportunities in the U.S. cannabis remain strong. Over the past several years, our playbook of expanding our business beyond cannabis to adjacencies and complementary markets has positioned Tilray well for the current environment as well for future growth opportunities. While we currently do not engage in any U.S. cannabis operations because of federal regulations, we're well positioned to participate and win in a federally legalized market when that changes either rescheduling or medical cannabis or the passage of federal cannabis legalization. Given our deep knowledge, global expertise in medical and adult use cannabis, and the regulatory compliance apply, Tilray's playbook in the U.S. is to build and deliver iconic sought-after brands in the beverage alcohol and the CPG backed by product excellence and innovation. Educate consumers about our brands and our stringent quality standards to encourage trial and foster loyalty. And last but not least, to drive and scale and distribute to get our brands into consumer hands to grow our market share. Moving to our beverage segment, which is quickly approaching approximately $300 million annualized. As mentioned earlier, Tilray Brands is now the 5th largest craft brewer in the U.S. with a 4.5% craft beer market share, and we aspire to be a top 12 beverage company in the U.S. Q3 beverage alcohol net revenue was $54.7 million, representing 165% growth year over year. Tilray now holds a 4.5% of the craft beer market share in the U.S., and we're just getting started and ramping up. Of this, our legacy brands of Sweetwater, Montauk, Alpines, Nelson, and Green Flash demonstrates our ability to successfully grow existing brands along with our recent acquisition of 12 craft brands from ABI InBev. We have gained in scale and see further expansion opportunities. Sweetwater remains the #1 brand family in Georgia, multi-outlets. Montauk remains the #1 brand family in Metro New York, having increased its distribution by 28% versus last year. Tilray is now the #1 craft supplier year to date in the Pacific Northwest. 10 Barrel's volume growth increased by 413 basis points since Tilray took over the brand, and we're now capitalizing on the success of 10 Barrel Pub Beer brand extensions by adding Pub Ice, Pub Cerveza line extensions, both innovations we're extremely excited to launch. Growing 24%, Pub Beer is now a top 20 brand on the West Coast with only half the distribution of top competitors due to its focus on the Pacific Northwest states. Still, our ambition is to be much higher as we're aiming and uniquely positioned to become a top 12 beverage alcohol business. This will be accomplished by leveraging our portfolio to win more occasions through core products such as craft beer and beyond, through innovation to categories like flavored malt beverages, ready-to-drink cocktails, and spirits. But ultimately, our plans go beyond alcohol, as we will be expanding into sparkling water, energy drinks, and other categories. This is important because we have the manufacturing facilities, the distribution, and the sales and marketing infrastructure to drive Tilray businesses. Working with BCG, we developed a clear and focused strategy to drive top line and bottom line growth for our beverage businesses. The three-pronged approach will deploy a regional strategy called Dual to stabilize scale brands such as Sweetwater, Montauk, Blue Point in their respective key adjacent regional markets across the U.S. and maximize their potential to gain market share from competitors. Dual is already paying off. According to BI sales to retail data, Tilray has increased its market share of total beer in 13 states, including key beer markets such as Oregon, Washington, Colorado, Idaho, Minnesota, and Arizona, when comparing share before and after the Kraft acquisition. In the Southeast alone, we've improved trends by 4.6% post-acquisition. For Q3, 10 Barrel has seen a 12.3% increase in distribution. Amongst our top 10 distributors when compared to the same time last year, and when comparing 6 months pre-acquisition with the 5 months post-acquisition, overall trends have improved 3.5%. Overall trends for Blue Point have improved 1.3%, while its number one distributor has improved trends by 3.8%, and those are just a few examples. We are also executing a national brand strategy, beginning with revitalizing Shock Top to win as a national craft beer over time by targeting share and connect occasions to reach mainstream male and female drinkers. We think there is tremendous upside with Shock Top, as according to our qualitative research, Shock Top has the highest purchase intent among 12 of the largest beer brands. This is why we're focused on increasing distribution and getting this brand back into the hands of consumers. We are already on our way. In Q3, Shock Top's number one distributor has increased distribution 24% versus last year, while on-premise distribution has increased 0.5% over last year among Shock Top's top 10 distributors. We are aggressively launching new and often disruptive innovation across our beer and non-alcoholic crafts to increase portfolio brand appeal to new consumers and new occasions. Many of our newly acquired brands have not had innovation in the last couple of years. Among many others, recent examples include Liquid Love for heartfelt hydration, Runner's High, a non-alcoholic craft brew for athletes, Highball and Hardball, a non-carbonated 10% ABV product sold in 16.9-ounce plastic resealable containers, and non-carbonated Shock Top Lit Hard Tea. Let me say that we're working to get the cost structure right, transforming the productivity and profitability of the breweries we acquire. We expect that our beer gross margins will increase once we fully realize the cost savings achieved in connection with the fully integrated beverage alcohol platform as we move away from the existing co-packing manufacturing agreements with ABI and increase our productivity in our newly acquired breweries and 13 brew pubs. Finally, let's discuss our wellness segment, represented mostly by Manitoba Harvest, which is fostering a positive impact on people and the planet through hemp by making ongoing commitments to sustainability with breakthrough initiatives such as investment in regenerative agriculture. Revenue grew 12% in Q3 to $13.4 million compared to last year. We partnered with bioactives company Brightseed to revolutionize the functional fiber market and breakthrough product, Manitoba Harvest Bioactive Fiber, which is now exclusively available at Whole Foods markets nationwide. Incredibly, 95% of Americans do not consume the recommended daily intake of fiber. This product provides 6 grams of both soluble and insoluble fiber per serving and is the only fiber solution containing 2 powerful hemp-based bioactives for gut health. Moving forward, the team continues to assess the opportunity to bring hemp derivative Delta-9 beverages to market under Happy Flower and Tilray brands. With that, I now turn the call over to Carl to discuss our financials in greater detail. Carl?
Thank you, Irwin. Recall that we present our financial results in accordance with U.S. GAAP and in U.S. dollars. Throughout our discussion, we will be referring to both GAAP and non-GAAP adjusted results, and we encourage you to review the reconciliation contained within our press release of our reported results under GAAP to the corresponding non-GAAP measures. Let's now review our quarterly performance for the 3 months ended February 29th, 2024. Q3 total net revenue rose to $188.3 million compared to the prior year quarter of $145.6 million, representing almost 30% growth. Excluding acquisitions completed within the fiscal year and the $8.7 million HEXO advisory fee captured in the prior year quarter, our legacy businesses remain consistent despite a 13% revenue decline in our lowest margin segment. We continuously emphasize the strategic importance of our adjacency business model, which is a key differentiator for us. This is best reflected by the contribution of our 4 segments to our overall results, which shows that we are not too dependent on any individual segment having a disproportionate impact on our sales or profit growth. Each segment is also, in our view, on a path to sustainable long-term growth. Looking at each segment now, during Q3 and compared against the prior year period, net beverage alcohol rose 165% and represented 25% of our total revenue mix, more than double relative to last year's 14% of total mix. Net cannabis revenue rose 33% and represented 34% of total mix, up slightly from 33% last year. Distribution revenue decreased 13% and represented 30% of total mix, down from 45% last year. And wellness revenue rose 12% and represented about 7% of total mix, down only slightly from 8% last year, respectively. Diversification is also reflected in our geographic footprint. During Q3, more than 62% of our net revenue was generated in North America, roughly 36% was generated in EMEA, and the remaining 2% coming from other parts of the world. This compares to about half from North America and EMEA in Q3 last year, with the variance related to the North American acquisitions we completed since that time, namely HEXO, the craft acquisition brands, and the remainder of Trust Beverages. Let me first touch on the key current item related to cannabis before moving on to a discussion on profitability. We incurred $21.8 million in Canadian cannabis excise taxes during Q3, which are a reduction to revenue, compared to only $13.6 million last year. The increase in excise taxes is reflected by a sharp increase in cannabis revenue generated in Canada versus the year-ago period, due in part to the HEXO and Trust acquisitions and a change in our revenue mix to higher excise tax products. Through the first 3 quarters of our fiscal year, we've incurred more than $75 million in excise taxes versus $47 million for the year-ago 9-month period. For many quarters, we have been on the record with respect to the inherent unfairness as to how the excise tax is predominantly computed, which is largely a fixed price on grams sold rather than as a percentage of the selling price. Because the selling price has declined meaningfully since the law was first enacted in 2018, it has made the excise tax a larger and larger component of net revenue over time, particularly as current growth categories like infused pre-rolls and concentrates become the biggest part of our sales mix. To prove this point further, excise tax amounted to 32% of gross Canadian cannabis revenue in Q3, compared to 26% in the same quarter last year. While through the first 3 quarters of the year, excise tax came to 34% of gross cannabis revenue versus 27% for the first 9 months of fiscal 2023. In our view, and in the view of so many others, this price-based tax structure is crippling, as it has allowed taxes to spike as the price of cannabis has declined by more than 50% since legalization. In late February, the Canadian House of Commons Standing Committee on Finance issued a report outlining several recommendations regarding the regulated adult use cannabis industry, including the recommendation to adjust the tax structure. Recommendation 329 in particular calls on legislators to make adjustment to the excise duty formula for cannabis so that it is limited to a 10% ad valorem rate. If enacted, this would be a welcome change that could result in $80 million in annualized revenue for our cannabis business, which would largely fall to the bottom line. The key to the government's plan and needed relief for our industry is that the provinces not enact their own excise tax to reflect the loss in taxes they are reaping from the status quo, increase their profits at the boards, or mandate that the tax savings are passed on directly to the consumer in the form of lower pricing. The budget announcement is next week, and we'll be following developments closely, but are resolute in our view that reform is greatly needed and measures must be enacted to stabilize the Canadian cannabis industry. Turning back to our performance, gross profit was $49.4 million compared to a loss of $11.7 million in the prior year quarter, while gross margin increased to 26% from negative 8% in the prior year quarter. Adjusted gross margin decreased to 27% compared to 30% in the prior year quarter. I will discuss adjusted gross margin by individual segment in a moment. However, the majority of the decrease relates to the addition of the new craft brands, which are subject to a co-manufacturing agreement with ABI until at least the end of Q1 next year, and the prior year figure including the HEXO advisory fees. Net loss improved to $105 million compared to a net loss of $1.2 billion in the prior year quarter, which included $934 million of impairments. On a per share basis, this amounted to a net loss of 12 cents versus $1.90 in the prior year quarter. Recall that last quarter we introduced two new reporting metrics to our discussions: adjusted net income loss and adjusted earnings per share. The definitions of both are identified in the press release, along with the relevant reconciliations and calculations. For Q3, we are reporting an adjusted net income of $900,000, which when calculated on a per share basis results in EPS of 0 for the quarter. Adjusted EBITDA was $10.2 million, down from $13.3 million in the prior year quarter. This is mainly a consequence of the negative impact the cannabis gross margin related to wholesale revenue, the termination of the HEXO advisory services contract upon our acquisition of HEXO in June, and the co-manufacturing agreements with the new craft brands, as I will explain shortly. During the quarter, we made great progress against the HEXO synergy plan, which we had previously increased to between $30 and $35 million. As of the end of Q3, we achieved $27.5 million in savings on an annualized run rate basis, of which 15.6 represented actual cost savings during the period. Operating cash flow was negative $15.4 million compared to negative $18.6 million in the prior year quarter. This improvement in cash used during Q3 this year was primarily related to achieved synergies of previously identified cost savings plans. Turning now to our four big business segments. Beverage alcohol revenue was $54.7 million, up 165% from $20.6 million in the prior year quarter. The positive delta was due to contributions from the craft brands, which were purchased last fall. However, we note that the impact of dry January was far more of a headwind than it was for the industry in previous years. Beverage alcohol gross profit increased to $18.9 million compared to $10 million, while beverage alcohol gross margin decreased to 34% from 48% in the prior year quarter. Adjusted gross margin fell to 38% from 53%. Both of these outcomes were a result of the craft brands, which currently have lower margins than our historical business. This is primarily due to co-manufacturing agreements for brewing. For greater context, adjusted gross margin for our legacy beverage business was 59%, compared to the prior year quarter of 53%, primarily as a result of an agreement with a distributor related to our spirits business. Adjusted gross margin from the craft brands was 26%. The improvement of gross margins in the beverage alcohol business, primarily in the beer portion of the business, represents a major focus for the organization. Gross cannabis revenue of $85.2 million was comprised of $62.1 million in Canadian adult use revenue, $14 million in international cannabis revenue, $6.4 million in Canadian medical cannabis revenue, and $2.8 million in wholesale cannabis revenue. Net cannabis revenue, which excludes the aforementioned $21.8 million in excise taxes, was $63.4 million, representing a 33% increase from the year-ago period. The positive variance is related to the increased organic growth of over 14%, combined with contributions from the acquisitions of Hexo and Truss. Offsetting the increase in net cannabis revenue was the elimination of advisory services revenue totaling $8.7 million from the prior year quarter due to the Hexo acquisition, which terminated the previous strategic arrangement that was in place. While revenue from Canadian medical cannabis grew only slightly, as the category is being impacted by competition from the adult use market and its related price compression, revenue from Canadian adult use rose 37%, which was driven by new product innovation and increased revenue from Hexo and Truss. International cannabis grew 44%, largely because of growth in our existing markets and the expansion into emerging international medical markets. Wholesale cannabis revenue increased to $2.8 million from essentially zero last year, as these sales are opportunistic and variable. We entered into this wholesale agreement to optimize our inventory levels and prioritize the generation of positive operating cash flow. However, it unfavorably impacted our gross profit and EBITDA. Cannabis gross profit was $20.9 million, and cannabis gross margin was 33%, compared to negative $32.8 million and negative 69% in the prior year quarter. Excluding the impact of the non-cash fair value purchase price accounting step-up and inventory valuation adjustments, adjusted gross margin decreased to 33% from 47%. As I said earlier, a portion of the margin decrease is a result of the termination of the Hexo Advisory Services Agreement, which contributed zero gross profit in the current year compared to $8.7 million in the prior year, which, if excluded, would decrease adjusted gross margin to 35%, essentially meaning that our cannabis gross margin was largely flat year over year. Distribution revenue, derived predominantly through Tilray Pharma, decreased 13% to $56.8 million from $65.4 million in the prior year quarter. Revenue was negatively impacted by infrastructure outages and weather, which impacted revenue by just over $3 million, and short-term challenges related to new rebate regulations. Tilray Pharma gross profit decreased to $5.6 million compared to $7.5 million in the prior year period. Tilray Pharma gross margin decreased to 10% from 11% in the prior year quarter because of product mix. Wellness revenue grew to 12% at $13.4 million from $12 million in the prior year quarter. The increase was driven by our strategic focus on targeted advertising campaigns aligned with emerging trends in healthier lifestyles, particularly around the new year, coupled with our continuous innovation efforts. Wellness gross profit was $4.1 million, up from $3.7 million in the prior year quarter, and gross margin held at 30% compared to 31% in the prior year period, as we experienced a change in sales mix towards more bulk retail sales. Our cash and marketable securities balance as of February 29th was $225.9 million, down from $408.3 million in the year-ago period. The majority of the variance was related to the payment on maturity of the Tilray 23s, our cash acquisition of the new craft brands, and settling assumed liabilities from Hexo, including unpaid excise tax, as well as legacy litigation settlements. Having now completed 3 quarters of our fiscal year, it is clear that our prior fiscal 2024 guidance of adjusted EBITDA between $68 and $78 million is no longer feasible. We have therefore lowered our adjusted EBITDA range to be between $60 and $63 million, which takes into consideration our performance through the 3 quarters, over $12 million year-to-date in price compression in the cannabis business, and continued expectations for the fourth quarter. Still, the fourth quarter represents a major increase from the current quarter, which is traditionally our lowest quarter due to the seasonality within our segment. The fourth quarter seasonality improvement is a function of our beer business leading up to the summer, a historically busy season, new innovations scheduled to be launched as part of the spring reset, new innovation in our cannabis business along with expected wholesale sales, and in our distribution business as pharmacies buy in bulk for their customers ahead of them going on summer vacation. Recall that we also projected positive adjusted free cash flow from operations for the entire fiscal year, excluding our integration costs for Hexo, Trust, the new craft brands, and the cash income taxes associated with Aphria Diamond. Due to the timing of collecting the cash on the various asset sales mentioned, we now do not expect to achieve this prior adjusted free cash flow guidance. While we were adjusted free cash flow positive in the current quarter, our current expectations are for a very strong fourth quarter of adjusted positive free cash flow. Of course, we will continue managing CapEx as part of our efforts to strengthen our industry-leading balance sheet. Let me now conclude our prepared remarks and open the lines for questions from our covering analysts. Operator, what's the first question?
Thank you. Just as a reminder, if you'd like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you'd like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. Our first question comes from the line of Andrew Carter with Stifel. Please proceed with your question.
Hey, thank you. Good morning. Wanted to ask about the German changes. I mean, obviously, it's going to likely manifest in a big uptick in patients with doctors now having more freedom to prescribe cannabis. But kind of thinking through this competitively, how do you see this as your position unique in being able to attack this market? I know that, you know, for the past 5 years, we've seen a lot of decks with Germany circled and capacity to hit that market. Is that capacity still out there? How expensive it is to maintain this? And can you give us a reminder of kind of the stringent quality standards you have to have in place to serve the German market? Thanks.
Andrew, thank you, and great question. Number one, listen, we see the opportunities in Germany in multiple ways. We have a facility in Germany today, and that Germany before only would serve as a tender to the German government. Now that tender process will go away, and we'll be able to sell product into the marketplace. So that's number one. Number two is before only a certain amount of doctors were able to prescribe cannabis. And it was a very small amount for specialty reasons. And now every doctor, because it's no longer a narcotic, will be able to prescribe cannabis. Number three, you know, we also have a facility in Portugal, which will be able to supply Germany. Number four is we have something called Tilray Pharma, CC Pharma, which is a distribution company that distributes cannabis and other medicines to over 13,000 drugstores. We have a team based in Germany. We have a sales team based in Germany. We have R&D. We have quality assurance. So we've been there for 4 or 5 years. And we've had some tough 4 or 5 years because of what's happening. The other big thing here is, you know, Europe is a big country. And, you know, with no longer being a narcotic and decriminalized, we see lots of other places, you know, countries opening up. I have Denise Faltacek here as head of Europe. Denise, is there anything I missed here or anything that, you know, you should add?
Yeah, no, Irwin, you did not miss anything. Just to add a little bit more in terms of facts. So in terms of that abolishment of the tender that Irwin spoke about, and the fact that under the new regulations, we'll be able to apply for a license with our facility in Neumünster. So today, just to refresh, you know, everyone's memory, we are subject to a tender contract. We are capped at about 1,000 kilograms that we can grow every year, and that is done pursuant to certain pricing. So with the abolishment of the tender, we now open up into a licensing process where we are now subject to just market conditions as it relates to patient demand. And so we can utilize that facility to meet that demand, which would allow us to increase our capacities. We have the ability to today grow up to about 5,000 to 6,000 kilograms without any additional CapEx. And we can basically then also have pricing that is subject to market demand today. So that is an immediate benefit there. In terms of the ability to prescribe, we are amping up our ability to be in front of doctors and working on symposiums and educational platforms. One of the things we've done on the prescription platform software, if a doctor wants to prescribe medical cannabis, they go to that page and there's a Tilray banner at the bottom which shows all of our portfolio of products, what the conditions are, how to prescribe. So we are out there also providing basically information for doctors who are willing to prescribe and want to prescribe.
I think the big thing is, Andrew, we do have a brand in Tilray brand, but, you know, the whole thing of socialized medicine and prescription and paying for it, we see lots of changes happening. So, you know, we have been working in the German market in regards to, you know, products for pain, for anxiety, for sleep, for cancer, for epilepsy. So we've been all over that and take our expertise of what we do at medical cannabis, you know, in Canada and translate it there. And secondly, like I said, there is a market out there that will be looking for medical cannabis, but ultimately using it for recreational cannabis. So from a standpoint, we really are excited about what's happening in Germany. It does not affect us in regards to the social measures that have come in place there. And, you know, we have the team, we have the grow, we have the infrastructure, the research and development ready to go here, and it's, you know, effective now.
Thanks. I'll pass it on.
Thank you.
Thank you. Our next question comes from the line of Nadine Sarwat with Bernstein. Please proceed with your question.
Hi, thank you. Two for me, please. First, on the guidance, I appreciate the added color that you gave. Could you be a little bit more specific in perhaps what exactly has changed versus last quarter and this quarter? What sort of surprised to the downside, and how do you see that progressing over the quarters to come? And then my second question, I know you guys called out your number one position in Canadian cannabis. So looking at the market share numbers you guys quote in the press release, I think that's on the downward trend for the last couple of quarters. So could you break down what's driving that, and if you think you can regain that over the quarters to come, and if so, how do you anticipate doing that? Thank you.
So I'm going to start part of it. Number one, not all quarters are equal. This third quarter being one of our lowest quarters in regards to bev alcohol in our cannabis business, our fourth quarters and our first quarter, second quarter. So that's, you know, as you look at our quarters, and absolutely there's seasonality within all these businesses. Secondly, we did lose some share in Canada. Some of it was, again, coming back to price compression, and some of it was coming back to some of the prices in regards to our flower. The other thing what happened is we have a lot of innovation that was coming into the marketplace that we didn't get into the market, you know, in our third quarter, which we expect, you know, to get back in our fourth quarter. I think, you know, what's important here, again, there's been lots of price compression in Canada. There, in regards to, we talked about our percentage in excise tax, and the market is changing dramatically there in regards to potencies and being, you know, infused pre-rolls, et cetera. So some of it is just timing, and do I expect to get it back? Blair, you're on the line. Do you expect to get your share back?
Yeah, thanks, Irwin, and thanks, Nadine, for the call. Just to add a little bit more color to what Irwin was talking about, Q2 and Q3 were our most operational complex periods. So in addition to what Irwin talked about, what we also saw is when you are moving the location of SKUs and where they're going to be distributed from, and one of the things we've done is centralized all our packaging and logistics out of Leamington. That requires us to draw down inventories in each of the boards and then rebuild that inventory once we've changed the source location. So what you're seeing in some of the numbers is, in addition to the price compression Irwin talked about and the innovation side, is just a reflection of the operational complexity we implemented in Q2 and Q3. Once that is completed, and it was all completed inside of Q3, that will generate very strong operational efficiencies for us moving forward, as everything outside of beverages will be shipped out of one location.
Carl?
Yeah, so just I'll add a couple things to the explanation as well. In our beverage alcohol business, and I think in the entire industry, was hit a little bit harder than it has in the past in terms of dry January, and that took away a bit of a portion of our sales expectation for the year. The beverage alcohol business with the new acquisition of the new brands, those brands are at a lower gross margin than the rest of our businesses. We're working very hard to bring those pieces up, and we will get that up over time. As I said in the script, we expect to be able to bring those up much closer to the historical margins that we've achieved, but it's going to take a few quarters, and so it's coming. It's really a function of the co-manufacturing agreements that we have, and getting that production moved and into our facilities and organized in an effective manner while not causing operational problems during that move. And in terms of the free cash flow guidance, we had some expectations on cash receipts on some of the bigger things, including some of the make-whole provisions inside of the spirits business, which we now see coming in June or July as opposed to in May, and that's really what's led to that change.
I think the big thing here is just timing, and that's, I can't always predict things. And, with our beer businesses, the ABI businesses bought lower margins, but just from an integration standpoint, we had a transfer service agreement, with ABI. We're moving away from that at the end of May, moving it into our facilities. We expect to get our margins up into the high 30s, low 40s. Today, with our Sweetwater and our legacy businesses, we're running margins at that rate. So, with that, we look to those margins. In regards to, the Canadian cannabis businesses, as Blair said, integrating HEXO with SKU rationalization, with some of the strains and looking at some of the potencies and timing. And when you're dealing with agriculture products, not everything moves accordingly here. We've made some moves in regards to, our Cayuga, in regards to Maison, in regards to Belleville, and consolidating our businesses there, taking out costs. So again, as we look at guidance, yes, there's guidance out there, but a lot of it is just timing. And as we move forward, we have 4 quarters, not 6 quarters. If it was 6 quarters, it would be different.
Understood. Thank you.
Thank you.
Thank you. Our next question comes in the line of Aaron Gray with Alliance Global Partners. Please proceed with your question.
Hi, good morning, and thank you for the questions. This is Remington Smith on for Aaron Gray. My first question is, in terms of the CRA having the provinces garnish wages, have you started to see any changes in purchase habits from provinces or the overall competitive environment yet? And then with kind of greater focus on those LPs paying their taxes?
I don't think we've necessarily seen changes in purchasing patterns. I think we saw very quickly after CRA started garnishing those wages, a couple of LPs filed for protection within the same week. And then I think there's been a few more that have filed since that period of time. And so, someone who's excessively behind on their excise tax and having their payments garnished are looking at 4, 5, maybe 6 months of time before they're going to get their next payment. They just don't have a lot of choices, and so they're having to file for that protection. I don't think the boards are actually changing those patterns yet. I think that'll probably happen over the next 3 or 4 months as more of these LPs realize and get caught up in the garnishment.
But there's a lot of the boards out there that have been asked by the CRA to garnish excise tax when they sell into it. I think the big thing for us is we're finally seeing, the Canadian government taking this serious. And those that, weren't paying excise tax could keep going and, putting the rest of us at a disadvantage. So I think we're going to continuously see changes. And, we've talked about the study that's come out there in regards to changes in regards to excise tax and marketing, medical cannabis, et cetera. I think there's some major things here that could really benefit the Canadian cannabis industry.
Great, thank you. I appreciate the color there.
Thanks.
And then my second question. Oh, go ahead.
No, go ahead.
My second question, just in regards to the excise tax changes that you mentioned, that could potentially occur in the budget that's released next week. You mentioned tax savings potentially of $80 million for Tilray. So I guess with those savings, do you expect it to mostly be realized by the LPs, or could there be, some benefit realized from the provinces and the retailers as well? Any color that would be helpful.
Good question. I think as we know provinces and we know governments, I'm sure they're going to try and grab some of that. But I think, listen, as we've said, and we've openly said, it's about $80 million, to Tilray. And the big thing is you got price compression, and you still have the same amount of excise tax that you're paying. And, I think in this quarter it was 33% of our sales was going to excise tax. So something has to be done. I don't mind if some of it goes back to the governments on education, on promoting the safety, bringing awareness, marketing, and allow us to do these things. So, again, if we got half of it, $40 million back, we invest back in the business. I think it'd be tremendous beneficial, to Tilray and other LPs.
Yeah, and I think the key in this piece is that if the government's making the change to strengthen the industry because the tax became, in a way, oppressive, they need to avoid creating new things that pull that money back. And they need to allow it to go to the industry to help the industry continue to grow and strengthen.
Great. Thank you for the answer there.
Thank you. Our next question comes from the line of Bill Kirk with Roth MKM. Please proceed with your question.
Thank you for taking the questions. Maybe I missed it in the prepared remarks, but what is the $29 million in assets that have been moved to held for sale? I imagine some of it might be facilities that you mentioned earlier, but what specifically is in that number, and how is it determined?
So that number is the Cayuga facility, it's Masson, and it's the Belleville facility that we acquired as part of trust. And so in each case, it's a facility, it isn't the business. The business is being reorganized within our existing footprints. And then we're releasing or selling what becomes redundant assets at that point in time.
Okay, got it. That's what I was looking for on not the businesses. Okay, and then in the third quarter compared to 2Q, selling marketing expenses up a little bit.
Did we lose you, Bill?
I'm sorry. It seems that his line may have a technical difficulty. Our next question comes from the line of Michael Lavery with Piper Sandler. Please proceed with your question.
Thank you. Good morning. Just wanted to touch on the U.S., and I understand at the moment it's, strictly speaking, a little bit hypothetical still, but if rescheduling occurs, you laid out at a high level how you're thinking about it and a more pharmaceutical approach. I guess a couple questions is it just maybe what's your patience level if it does come to that, just because the FDA certainly is known not for its speed. And so, is your understanding just, that obviously if that door opens, it could still take quite some time, or how are you thinking about that? And in the release as well, you reminded us about the connection to MedMen, and how would that fit into that potentially? Is that something that would still stay separate or could potentially become sort of like pharmacies? I guess just maybe lay out some of how you're thinking about potential U.S. opportunities should regulatory change come through.
So as I said, within the U.S., if medical cannabis is rescheduled and medical cannabis becomes legal, We being, a large medical cannabis producer in Canada and Europe and have the expertise and have the research, not knowing what the FDA and not knowing in regards to, what the guidelines will be, Tilray is ready to capitalize on all our expertise. Is there a possibility with NAFTA or with other rules that we can, export cannabis from Canada that's GMP certified? Today, you can export, cannabis from Canada to other parts of other countries around the world if it's GMP certified. So I'm not sure why that wouldn't be the case in the U.S. if that happens. My personal belief, if it's rescheduled from a medical cannabis standpoint and they leave it up to each of the states on a recreational standpoint, then, that is something different. So I think the big thing is I look into a crystal ball not knowing where this is going. I think something happens from a rescheduling standpoint. And, Tilray is ready to move from a medical standpoint. If there was an acquisition for us, we're ready to move. And, we hold the debt of MedMen. We think the MedMen name still has a strong brand name, even though it's had its challenges and it's going through, some changes right now to get rid of some of those liabilities and that. And there's an opportunity that, we could execute with the MedMen name across the U.S. The other thing is depending, and I think one of the biggest opportunities, and we're seeing, some opportunities with Delta-9, which is infused drinks with hemp-infused THC. I think the biggest opportunity is in drinks. And with our distribution systems, with our brands within our beer business and spirits, Tilray can get into that. So, not knowing and not, what's going to happen, I think, as I said, Tilray is circled in the U.S., and it's not like we'd have to change their model being an MSO where we're, restricted to each state. Right now, we could take our expertise from around the world. We can take our medical expertise. We can take our beverage expertise and bring it to the U.S. once we know which way rescheduling happens and it goes. So that's where I'm excited about is once we know what the guidelines are, once we know what the opportunities are, we could easily jump in there without undoing something that we own today.
Okay, thanks. And just on the beverage side, you touched on your hopes for distribution upside on a lot of the, especially recently acquired brands. But do you have a sense how you coming into this spring's shelf resets and what sort of shelf space gains you're positioned for that are already in hand?
So hey, Ty, you're on the call, right? Do you want to jump in there? Listen, I got to tell you, in a short period of time, a lot of these brands were just starved on innovation, starved on distribution. We have 500 distributors out there, and I always say to Ty, if each distributor could do $1 million more, which is not a lot, that's $500 million. So I think the upside on beer is tremendous. As you look at pricing, you look in regards to the whole spirits industry. I think we're so well positioned on beer, on innovation that we're coming out with, moving into water, moving into some energy drinks, moving into some other infused drinks. So we're well positioned with our distributors. We have over 100 salespeople and, headquarter people between marketing. So Ty, you want to just talk about some of the stuff that's happening?
Yeah, no, thanks, Irwin, and thanks for the question, Michael. Yeah, no, we feel really solid about some of the distribution gains, not only that we've made in the third quarter, but we also feel solid about the conversations we're having with, several national and regional retailers across on and off premise with our brands. Specifically, if I look over Q3, we've gained north of 1,200 new effective placements on our existing brands. And with the innovation, we continue to see uptick every day with our distributor network and how they're leaning in with us and helping drive distribution. So, chains are going to continue to play a critical role in our success, and we're well suited, as Irwin said, to leverage our partnerships with our distributors and the relationships that we have across the U.S.
Okay, thanks so much.
Thank you. Our next question comes from the line of Matt Bottomley with Canaccord Genuity. Please proceed with your question.
Good morning, everyone. This one's for Carl. I just wanted to go back to the revised guidance here on adjusted EBITDA going into fiscal Q4 here. So I'm just wondering if you could give a little more color on the dynamic between overall revenue progression versus margin expansion. There's obviously quite still a big step up expected even in the revised guidance. And then specifically within that, I'm wondering how much of that is beverage related, given that I think you had commented that you're close to about a $300 million business now in all your beverage portfolios. If you run rate this quarter, and I understand there's seasonality, it's closer to 200 to 225. So I'm just wondering if there's some step up on the revenue side, specifically in Q4 when it comes to your alcohol contribution.
So thanks, Matt. There is significant increase in sales in Q4 in beer. I think we've talked a little bit already on the call in terms of the spring reset and hitting those the key summer selling season, which is really driven in our April and May sales results for the organization, particularly in beer. We've talked a few times about challenges in the spirits business with sales growth, and that we were going to get resolution of that in Q4 of this year. So that's also reflected inside of those that expectation on EBITDA. It's potentially driving both revenue and margins during that time period. I think on the beer business's margin side, you are going to see an increase in margins in Q4. That'll be driven by just more volume flowing through the facilities as we ramp up production in March and April to hit those April and May sales, because there's such quick turnaround time and lack of inventory inside that segment. You've also got the build up on the cannabis business for the summer period of time, and increases in things like pre-rolls and other product forms in the cannabis business that are consumed on a more of a, let's call it a shared basis, either in a shared setting or actually shared on its own. And so that's a part of it, and with that increased sales level comes increases in margins just because of efficiency on the production side.
Okay, very helpful. Thank you.
Thank you. Our next question comes from the line of Doug Miehm with RBC Capital Markets. Please proceed with your question.
Yeah, thank you and good morning. Question just has to do with, again, the excise tax and going back to this. There's obviously an opportunity for your company, but I am curious if these changes were to go through and you benefit somewhere between 40 and 80 million the way you expected. What's your thinking on the other companies? Because we're starting to lose some of the smaller companies, but is this going to provide the smaller companies with another year or two of life? And I'd say the other thing that I'm curious about as it relates to this, could this result in another leg of downward pricing as they try to maintain market share?
So I think a couple things. Yes, I think, if companies don't have to pay the same amount of excise tax that, everybody is, I think some of these companies absolutely will survive. And I think at the end of the day, we all want a strong cannabis market in Canada. The big thing is, again, what's got to change is the excise tax. And yes, we probably are the highest payer of excise tax in Canada. So for us to receive back, if it's $80 million, it's a lot of money. But at the end of the day, it's money that we're going to put into building our brands, building our products, our innovation, and hopefully marketing and building a bigger category out there. And I think that's ultimately the benefit, that the money's not going back to, taxes. It's going back in to build a marketplace and back into, continuously grow the industry. So yes, will more competition be out there? Could there be price compression? Absolutely. But I'll tell you what, I don't mind some more price compression. I don't mind some more LPs being in there. I wouldn't mind that $80 million coming into our, into our company where we can invest it back in our business and drive growth, drive, innovation, and drive marketing the brand to a much bigger category.
I think it's also important to understand that different entities are going to have different amounts of a win related to this, right? And as you get closer to the tail end of share, the impact for a lot of those companies is going to be a lot less. And if they're behind on their excise taxes, the excise tax garnishment may have the bigger impact for them. As Irwin said, we're on the opposite end of that tail because we're the largest. And then you've got a bunch of companies in the middle where, I think that is more towards where your question was, where you're going to see some people who will be able to survive a little bit easier.
And I don't think excise tax is going to keep everybody in business here, okay? I hope not. I think, I continuously see more consolidation in the Canadian market. I see, some of the smaller players ultimately going away. And I think that's what happens there as a new industry. There's just a filtration of, these LPs. If you come back and look at it today, 25 LPs make up about 50% of market share. There's about another 1,000 LPs that make up the other 50% market share. So, you see some consolidation. You see companies going away. And I think what this creates is a much stronger cannabis industry within the Canadian market. And if what happens also, as I said before, there could be opportunities for grow in Canada to be shipped into the U.S. and other parts of the world, which could, enhance the Canadian cannabis industry.
Okay, excellent. Thank you.
Thank you.
Thank you. Our next question comes from the line of John Zamparo with CIBC. Please proceed with your question.
Thank you. Good morning. My question's on the cost side, both COGS and SG&A, and there's just a lot of moving parts here, and I wonder how much FQ3 represents a run rate, because you've got additional synergies coming from HEXO. It sounds like you have savings on the beverage side as you move away from co-packing agreements, but you're also investing in innovation and product extensions, and it sounds like another variable is selling the production facilities, which I think you said saves $5 to $7 million annually. So I wonder, when you think about all of this in aggregate, is there a net benefit on the cost side, and do you expect to see total costs come down from FQ3? Because it seems like organic revenue growth is a bit more difficult to achieve near term. Thank you.
So first off, I think, organic growth is going to come, particularly in the fourth quarter. As we see the new launches and the new innovation hit the market, particularly in some of these new categories that we're doing on the beverage alcohol side, including the water and the non-alc, and playing in that space, playing in the FMB hard tea space, things like that are new categories for us. And so I think there are opportunities for organic growth. But, if you're using Q3 as a baseline, I don't think that's the right way to look at it. And similarly, I don't think Q4 is necessarily the right baseline and they're for the exact polar opposite reasons. Q3 is traditionally our lowest quarter in terms of revenue and production, and Q4 is traditionally our highest quarter in terms of revenue and production. So we're going to get an uptick on margins as a result of that incremental volume, particularly in beverage alcohol in our legacy business. And that's going to be what drives a chunk of the earnings guidance, and it's going to be what drives our results next quarter.
I think the big thing here is, too, you heard me say before, the savings we're getting from the integration of HEXO and Truss, and somewhere between, close to $35 million. We don't get that immediately. It evens out over the quarter, so it takes us a full year to get that amount. The second thing is, as we just own the ABI businesses for 2 months, and just, I 2 quarters, as we integrate them into our businesses and start from the procurement, from the distribution standpoint, I mean, there's a lot for us to get done here, but we're focused on organic growth and we're starting to see that already. We're focused on which facilities to integrate these products to, which states we're going to focus on. We also have 13 brew pubs out there that we're focused on growing our brands through these brew pubs. Big event for us, 420 coming up April 20. We have two big events, one in Atlanta and one in Long Island. And there's also, in every retailer, there's displays built out. So July 4th is one of the biggest, beer category months that is sold out there from occasions. So, right now, as we bring this together, and our aspirations is to grow our beer business to a $300 million business. And you got to remember, in 2020, we sold 2.5 million cases when we first acquired the Sweetwater brand. Today we're on a run rate to 12.5 million cases with tremendous opportunity with, all the innovation that's happening. So there's just a lot of evening out here, and there's a lot of moving pieces to bring all this together. And I think the big thing is as we look at it, when we get a full year behind all these acquisitions with Hexa, with Truss, and the integration there, we get all this, full year together with all the ABI stuff. We're seeing some great stuff. And listen, just with Montauk, we've owned it over a year, one of the, fastest growing beer within New York today. Some of the stuff we're seeing on the West Coast with Green Flash, Nelson's, and Alpine. So the legacy stuff that we've already bought and owned a year, we're seeing good results for it. It just takes us some time here to get these things integrated.
Okay, I appreciate the color. I'll pass it on. Thank you.
Thank you. Ladies and gentlemen, that concludes our question and answer session. I'll turn the floor back to Mr. Simon for any final comments.
Thank you, everybody, for joining us today. Listen, I wish I could predict what's going to happen in the cannabis industry. There's going to be one thing for sure I can predict: there will be change. And we've been waiting for change for a long time. In the German market, it finally came to fruition. And there's going to be a lot of execution to get it where it needs to be, but it's happening. I do think we've been sitting and waiting through the Biden administration before that change happened within the cannabis industry. There's lots of discussion about rescheduling. And again, it's not something we have control of. But one thing we do have control of, we do know how to grow cannabis. We do know how to sell medical cannabis. We know about research. We do have within Canada today over 5 million square feet of grow. We do have in Europe, 2 major facilities. And with that, depending what happens in the U.S., we will be ready to launch what needs to be launched into the U.S., whether it's taking from our existing businesses, acquiring, putting something together. We'll have the opportunity to do that. As I've said, our aspirations is to grow our beer business to a $300 million beer business. We already are the 5th largest craft brewer today within, the U.S. We have a great business within Breckenridge Distillery. We've been named some of the number 1, whiskeys within the world, within the U.S., and some exciting things happening. I'm also real excited about what's happening in our wellness business in regards to Manitoba Harvest and what's happening with hemp from a high protein food and now the perception of hemp as a great product and a healthy product. So, as Tilray Brands comes together over the last 5 years, there's a lot of real good pieces that ultimately will come together. There's tremendous opportunities with our products. There's tremendous opportunities with our distribution. There's tremendous opportunities as we build out, our global market. So, as I look at Tilray, we've circled a lot of the right wagons. And again, that dealing with regulatory, dealing with unknowns in regards to rescheduling, but Tilray is there. I'm real happy with the team that I have in place and excited to work with the team. We've done a great job in an industry in regards to banking, what we've done with our balance sheet, and we continue to work on that balance sheet. I'm someone personally that does not like debt. So how do we focus on our balance sheet? I'm very much in favor, and as I push with Carl and the rest of the team, cash flow and taking costs out of our business. And there's not too many other industries out there that are taxed the way we are on cannabis, on beer, and on spirits. And I wish Tilray was earning the amount of money that we're providing the governments of Canada, US, and Europe from our taxes that we generate from our business. With that, look forward to talking to you again soon. Appreciate getting on the call, and have a great week. Thank you.
Thank you. This concludes today's conference call. You may disconnect your lines at this time. Thank you for your participation.
Hey, all right, so I'm just going to go over some thoughts real quick on the chart before I close this down. And so really, I did go over them during the stream. And I also should note, if you did miss the live stream of the earnings call, did the whole thing, including all of the questions, I will put timestamps just after I end this, so make sure you check that out. Yeah, WS in the live chat saying a few catalysts coming this month. Have to head out. Yeah, good night then. Sleep well. Hope hump day goes well for you. I am fortunate I have tomorrow off, so I'm going to try to crank out a bunch of videos tomorrow and Thursday, just be productive. And I think after the stream, I'm probably going to catch up on some YouTube videos going over Bitcoin, the economy, stuff like that. And I can actually share those on the channel if you guys are interested in what I'm watching. But yeah, I just wanted to go over the chart, so number of things coming up this month, one being 420 is coming up. They did mention that. Then also July 4th, since they are a beer company as well. And yeah, so and summer, I mean, that's the perfect time for all of this stuff. So yeah, I mean, I feel like we're going to have a pretty, I'm excited about the cannabis sector and the way that they've expanded. I just think it's really interesting. And looking at the chart, I did point this out during the stream and also, I believe in the video, I just didn't draw lines on it. But I, drew these big yellow lines. So you have lower highs here in the stock price. And then in the RSI, you had higher highs here. I was just going to say, that this was a lower high, and so this was not bearish divergence here, but we did see a pullback there. And so, I don't know how far this pullback will go, but I do feel that, with this, it does look like there's some support here around $2, also that being a psychological level, this downtrend. And yeah, I mean, with that downtrend, I'll zoom out in a second. It does look like we've broken out of, a potential wedge or just above this downtrend, testing it as support. So I feel like that could be really good. And then if we do go lower, though, right around 190, this blue line, there were these gaps over here, gap here, and that, we did gap down to that level. That was, right around there was about resistance. Gap up, that was support, and we have all this consolidation below that level. And so I do feel like returning to the 786 at around 190, I think that could be the bottom, and maybe, I think ideally, we would just see wicks down to that level, no closes around that level, just wicks down, closes above. I think that could be a great dip buying opportunity, potentially a fake out dip buying opportunity. If we do get a close around there, look for the following close to be above this downtrend or, to be higher than that close below. And so I do think there's a lot of upside potential. And WS in the live chat was suggesting this could be going to 3 to 4 by the end of the year. I could definitely see that. If we do look at the chart, while this is a lower high from this one, if we do look from here, let's see. This is unfortunately a lower low here, but looking from the highs here, we have this low here, we have a higher high from here. Let's get a higher low, not going down to 160. Hopefully 190 is the lowest. And then that would be a higher low that could suggest that we would start to see some moves to the upside. And with that being said, I do have 336 highlighted here, corresponding to the highs over here as well as over here. I did also add 450 based on the high right around here. I think it was 452. I'm not exactly sure. I think that's 452. That we did get a wick high up just below that level and then kind of a fake out break above it here. And so I could see that. And then looking at the chart like this, if I do throw up the volume profile, we do start to see this consolidation here start to dip out around $4 a share just above. And so I do think that, $4 just being a psychological level. Also, I think with this sector, I think $4.20 is going to be a significant level. And I do think that we could be getting up there by the end of this year. And what we're looking at, in all of this price action here, going back to basically a year ago, almost a year ago, a year ago, all the way back to the beginning of 2023, just really below this line at 336. I feel like that was probably, it seems like great dip buying opportunities for, what we could be seeing in the future. If I do flip this over to the weekly time frame, just because it's been up in the past doesn't mean it will be up in the future. But I just think that, the way that they've been pivoting, restructuring, and not just doing cannabis, but also doing beer, whiskeys, and looking into exploring the beverage industry, which I think will also be, and so it'll be like sparkling water, energy drinks. I think that would also be complementary to infused beverages with THC, or any of those components from like CBD, whatever, CBD, CBG, CBA, CBC, whatever they are. So I think that there's just a lot of potential, not only for growth in this company, but growth in that industry as it becomes legalized, whether that's for medical or recreational purposes. There's just, the more medicinal applications, the more research that's done on it, the more ways we're going to be able to utilize extracts and whatnot from cannabis. Also talking about hemp, so I think that there's a lot of potential here. And I think that we have seen, really look at this. The all-time low, is this all-time low? 150? Yeah, 150 was the all-time low. We're still right around the all-time low. So this is, I think that this is a gift, what we've gotten following this earnings call. I think this is a gift. Maybe we go down to 190. Maybe we go down to 172, this orange line here. I think it's a gift. As long as we don't go below 160, if we do, I think that could continue lower. That could be bearish. But, we'll have to see. Overall, I'm excited about it, and I'm grateful for this dip because I was building my conviction here. I feel like I have a lot more conviction now, and I think that there's going to be a lot more upside this year. I think it could definitely double this year. I don't know that it would sustain might have trouble getting up there and pulling back, but then moving higher next year. I'm not sure. It's tough to say. But yeah, with this being an election year, I think that there's a lot of potential with this and the Schedule 3 talks. So, but yeah, I'm going to quit rambling. I'm going to put timestamps on this, and I'm going to enjoy the rest of my evening, and then I'll put out hopefully 4 videos. I think I could do 4 videos tomorrow. I'm definitely going to do Neo, and I'll do some other ones. But yeah, thank you so much for watching. I see there's just one person still here, so thank you for hanging out. It's been fun. Hope it was informational, educational, and enjoyable. I'll see you in the next video, and I'll be doing another live stream. Since this one was pretty long, I might wait until Sunday to do the next live stream, Ticker Request Live. But I'm looking forward to it. So thanks a lot for hanging out. I'll see you guys later. Good luck trading tomorrow, Wednesday, the rest of the week. Hope it's a good one for you. I'm looking forward to it.